Good to see you guys. How you guys doing?
We're giving control, we're giving liquidity back to investors, direct title, fee simple ownership, a 10-year credit tenant lease attached to them.
Obviously, you're not, going to shoehorn in a tenant for a 10-year commitment, right?
Since you own the house outright, it's not like you're going to break the lease to go find someone else. You don't need to. The point is that you can sell it with the lease in place anytime you want. If Appreciation Homes were to just go away, you still own the property.
A lot of people say, well, you got to replace debt. That's not true. Debt can go away either by going down in value, triggers tax, or by adding cash. Hello, everyone. David and Tom Moore, the Exchange Bros, and we're blessed to have a couple of our friends, actually. We were happy to be involved with the Emerson Broker Dealer Conference in San Diego last spring. And at that conference, we listened to 40 different investment sponsors presenting their different DST offerings and had several hundred financial advisors there. And a couple that really stood out to Tom and I were Forrest James and Derek Vogel. And Forrest, you work with Emerson. You've been there for a while. And Derek, we talked. Actually, we were blessed to have you guys out on the boat with us afterwards, just a little cruise. And I know Derek, you were in the Navy for a bit, and now the investment world's got you. So. With that said, why don't take a couple minutes, each of you, sort of introduce yourself and who you're with and what you're doing. And today's presentation is on actually Appreciation Homes, which is I think a very unique offering in the passive or mailbox money investment real estate space. It's 1031 compliant, which we're always looking to get information out to people as so they're aware of what they have on that menu of potential offerings. So Derek and Forrest, do you want to sort of kick it off and I'll get out of the way?
Sure, I'll start. I come from a very good financial background. I was a econ major from UCLA, and after that I was 10 years as a stockbroker in Beverly Hills, and then moved on to a hedge fund for about 13 years. After that, interest rates were pretty much near zero, and I thought, well, how can you make any money in these markets? And I discovered the alternative investment world. Yale, Harvard, their endowments, they did a lot of alts. So I thought, this is interesting. So we started working at Emerson Equity, and two partners I have, Mike Colwell, Kevin Hickam. We built quite a retail business here, and then we also started doing supervising for Emerson Equity, which is one of the leaders in the alt field. We do about 500 million to $1 billion in alts. The company Emerson does, most of it DSTs, and that's when we ran into this particular product, the DTS, as a good alternative to the DST. And so I'll let Derek take over from there.
Yeah, thanks. And just to say, it was a real pleasure meeting you guys in San Diego as well, David and Tom. I thought that the interaction right away was so organic. Tom's background with a record-breaking water polo career right here in Southern California. Loved hearing those stories. And anyway, I just felt like it was a very natural relationship that was built right away. So thanks for this time. But as you alluded to, yes, past life, had a career in the Navy. Got out in 2022 and got very quickly licensed up and hung my licenses with Emerson Equity. Started out really doing more compliance, making sure that trades were in good order from a lot of the Emerson reps across the country. That was a lot of the nitty-gritty work. A good way to learn the business. But eventually, I wanted to start getting my own clients and getting into the retail business, which I started doing basically about a year and a half ago. And was having a good career, a good start with that. But with what Forrest just alluded to, with the introduction of the DTS and with Emerson's involvement and just knowing what the market was really craving and needing in terms of an alternative to the DST, the DTS was so attractive. And when they came and to have Emerson be their managing broker dealer and they didn't really have a wholesaler, I said, hey, I would love that opportunity to talk about this, help you bring it to market through broker dealer channels, RIA channels. So very, very happy to be here, very blessed and excited to help, yes, educate the public and whether it be QIs, broker dealers, registered reps, advisors on the new exchange option that exists.
Maybe I'll take a few minutes to just describe how it was kind of born. About 8 years ago, we had done DSTs for a while, and the problem with DSTs, I mean, it's a wonderful investment. It gives diversification, it allows people to be in a bunch of different asset classes. The issue was always control and liquidity. So I had gone to a small company called Archon. They had a fund of maybe a couple hundred houses. And I said, do you think you could break off some of those for like an LLC for an individual client? They have $1 million exchange, maybe pull off 3-4 houses, and that would give them the control they want. So they actually did it. But then they had other issues. They just didn't manage the properties as well as they should have. So then I started working on NextPoint, which is a huge company, $1 billion company, very eclectic in what they do, a lot of DSTs. They also came out with some housing funds. So I was negotiating with them forever to try to do the same thing that Archon was trying to do. They said they could do it, but then that kind of fell through, never happened. And then finally, they came to me about a year ago saying that there's this new deal, Appreciation Homes. They're working with it, but they decided that it's best if they let someone else manage it. So they came to Emerson. So that's how we became the managing broker dealer of the product. So that's kind of how it started.
So Tom, you looked like you were going to say something. I don't know. You want to take a question?
No, I was just gonna have him give a real kind of dumbed down explanation, and you're doing a good job starting that out. But it's always really exciting to have a new product out there to offer up to clients, because our 1031 clients, they don't really always even know what like kind means and what they can go into. We still get people thinking that if they sell a single family, they have to go single family again, or if they sell bare land, it's got to be bare land, commercial. And so a lot of people are familiar with the DSTs at this point in time, and this just gives another great product for those that are looking for the hands-off type of property. And so I think we just continue with what you're talking about. Give an explanation of who is the ideal client that you see going into this product, and how much diversification can they get going into these? What about as far as where they can buy properties and what's always available at any one point in time?
And guys, exactly I guess, yeah, just real quick too. I think we're throwing around some acronyms, and the thing that drives me crazy in today's world is when we're like, even the DST, for example, we've got Delaware Statutory Trust, which is the context we typically are going to talk about, and then we've got Deferred Sales Trust that for some reason wants to use the same acronym, which is very confusing to people. So just for the sake of the audience, what define DTS?
Yeah, the DTS stands for Direct Title Security. I know it's the same 3 letters, just reorganized, probably going to confuse the general public all the more, but it is an appropriate acronym because, again, it's kind of like going back to the fundamentals, right? We're giving control, we're giving liquidity back to investors that they don't otherwise have in a DST, and we do that through direct title, fee simple ownership of residential real estate. So that's why it's a direct title security. And so yeah, to go back to Tom's, what is it? It is, yes, it's a portfolio of homes, one or more homes that we offer investors to buy, to purchase outright, fee simple. And when they own those homes come with a 10-year credit-tenant lease attached to them. So that we are simply the first to marry the very traditional triple net structure that's found in commercial, retail, industrial real estate with fee simple direct title ownership of residential real estate. So when we put those two things together, you get a very conservative up-leg solution for someone's 1031 exchange. The underlying real estate is a single family home in growth markets, and yet their investment in a lot of ways is backed by a triple B plus credit rated investment credit tenant. So you're kind of marrying the conservative natures of both of those real estate.
So these always come when, as soon as you buy into them, they're already leased with, and how long did you say that the lease is typically? 10?
Yeah, 10 years, but it can honestly be customized. We have a 10, a 15, a 20, a 30-year product, but for the retail market, a lot of your listeners will probably be, the DST type of investors, that fits the 7 to 9 year time frame. A lot of the retail clients are looking for a 10-year lease term.
And are these properties built for this, or are they purchased? What's the typical age of the units that people are buying?
Yeah, great question. Typical age is 1, 2, 3 years old. I would say that's 95% and more of our properties. And when I say our properties is where what we go put leases on is brand new Class A built for rent style homes. That big national or regional home builders and large institutions have in their portfolio. That is our inventory in a sense. We have relationships with big national firms that you would all hear about. We have relationships with big money centers, with big national brokerages doing our appraisals. Yeah, at Cushman and Wakefield. So anyway, we have a lot of relationships with big firms that kind of do that for us.
So Derek, if we look at let's Forrest, your background with let's say a traditional DST at this point in time. So typically we're looking at a sponsor that buys an asset and then sells off pieces of the asset or group of assets. DST could be a single asset offering or multi property offering. Institutional TIC is a single thing where the sponsor typically ties up the property, fills the bucket with investors, and buys it. When we talk about this product, as Tom was talking about, if we're looking at these houses, you're buying houses, packaging, and when we talk about a lease, that 10-year lease, that's not between the property owner and the tenant. It's between the property owner and Appreciation Homes, or I mean, what's that look like? Because obviously you're not going to shoehorn in a tenant for a 10-year commitment, right? So sort of explain what exactly is happening with that, and then. So obviously you're removing that person from having to deal with the heartache of owning and managing a property these days, but you're having the benefit of something that is not necessarily a big institutional property. It's something that may have some liquidity that might not typically be offered in a traditional DST offering too.
Yeah, it's very much like the DST in the sense that you have a master tenant. Okay, so the difference is that they are just a master tenant. They are not in control of the property. In a typical DST, the sponsor controls everything. They're the property manager or they outsource it, but they have ultimate control. So you're usually in them for 4 to 7 years. If there's debt on it, it's typically a 10-year debt, but they tend to exit within 4 to 7 years. In this particular deal, the master tenant is Appreciation Homes. However, since you own the house outright, it's not like you're going to break the lease to go find someone else. You don't need to. The point is that you can sell it with the lease in place anytime you want. So there's the control. The liquidity comes from, unlike a DST, which has a series of rules that you have to follow. For example, you can't change the debt. You can't refi debt. You can't add debt. Okay. Where in this particular deal, you have fee simple ownership. You can get a bank loan if you'd like, or you can actually get the money from Appreciation Homes themselves. They have a white labeled bank debt that they give to you, which doesn't charge you extra for non-owner occupied, which a typical bank would. They're also non-recourse, which is opposite of what a bank would. And so it makes it really simple, no major underwriting. So unlike a bank where you have to qualify usually, not in a DST, but in a typical you own your own place and you do it yourself. The main difference between the two is that with a DST, the master tenant, the sponsor, has still the risks of property tax increases, property insurance increases, maintenance issues, but most importantly, vacancy issues. In the DTS, the master tenant, Appreciation Homes, it's actually a quadruple net lease, not a triple net. They also cover the roof or any structural issues. But more importantly is that if Appreciation Homes were to just go away, you still own the property, okay? And it most likely has a subtenant in it, because Appreciation Homes is the master tenant. So whether your place is occupied or not occupied, you're still going to get paid the rent every month. It's kind of like the insurance model. They pool all these houses together. So all in all, it's a better structure. I think it's safer for the clients, and I think that the yields actually are a little higher than DSTs also.
What sort of inventory is available to choose from at any one point in time?
Yeah, so I mean, we have the ability to go put leases on many different homes in many different markets coming from different regional, national home builders and institutions. Right now, our inventory very much consists of southeastern homes and markets. So Alabama, Georgia, Florida, Texas, Tennessee, Oklahoma. Those are some of the big markets that we're in right now. And we could provide inventory right now, say, hey, here's a portfolio of $1.5 million portfolio of 5 homes that you can exchange into today. But if there's another investor that says, hey, you know what, I really like the Arizona market, or I really like the Ohio market, there's definitely, they have markets that fill our buy box or our long-term, where we see long-term growth and rents happening. So we would go put leases on homes there for, depending on the client and what they're looking for. So we have an inventory, but we have a capability of putting leases on homes across the Sun Belt, really 15 different Sun Belt states.
Yeah, and if somebody comes in and they've started an exchange and they're looking for something in a different state, maybe there's not any current inventory in, say, Arizona, and I want something there or in that Midwest area. What's the time frame? I mean, it's still got to be able to comply with the 1031 timelines. Is it a pretty quick process?
Yeah, no, that's a great question. So I would say, we make it quick, but we can never be as quick as a DST that's off the shelf, ready to go, right? Someone can just point and click at a DST and say, hey, I can exchange into that within 24 hours. We need a little bit more time. So if we could put together a portfolio for someone, probably within 48 hours of saying, hey, here's your $1.5 million exchange, here's homes that you can exchange into. Now, if they don't like those homes or they want to see a different market, give us another 48 hours. We can go find other homes. So anything
that's pretty reasonable. That's pretty reasonable. Yeah.
Yeah. So, but it's not, if someone comes to us on the 43rd day, right? They have 2 days left to ID. It's going to be tough. We would probably bend over backwards to try to make it work, but there wouldn't be a lot of negotiating at that point in time. It would be, here's a portfolio for you. Here's real addresses. You can ID these addresses. But yeah, I mean, ideally we have more time to work with the investor and the rep and say, where does this client want homes? And here's the portfolio. What are your thoughts? And have some dialogue.
Great.
But they're literally identifying specific properties. So unlike pieces of the other offerings, a couple comments on what you've said, I think that are exciting, at least for people that really want to think about it. The fact that you talked about the debt on these things and getting access. So correct me if I'm wrong, but it sounds as though obviously with the exchange, we've got value and equity requirements that need to be met through the transaction. So you got to go across or up in value and equity. A lot of people say, well, you got to replace debt. That's not true. Debt can go away either by going down in value, triggers tax, or by adding cash. But if I heard you correctly, it sounds as though we can complete the transaction into your product. One, it's non-recourse debt, which is beautiful, right? But two, after we've buried all the money, spent the money on this stuff, it's possible to do effectively a cash out refi after acquisition?
Yeah, I mean, that's the beauty of it. Let's say, for example, my estimates are 1/3 of all exchanges are cash, and maybe it's going to get more, maybe it's going to get less. But if you come in with cash, you go into a DST, a cash DST, that's it. You have no liquidity options. In this particular product, if you come in with cash, a year from now, something comes up, you need some money, you can get it. You can either go to a bank or you can go to Appreciation Homes. You don't have to sell any of the assets. That's the beauty of it. And then the other asset is the underlying asset being a home. They can get debt levels close to, on the native house, 75 to 80%.
The loaded rate is around 65% is about where we tap out, which compared to other DSTs is quite incredible. So maybe a one-stop type of stuff.
But the ability, and Forrest, I know you've dealt with it through the years. You think about the number of people, and I, I've cringed. Tom and I have been doing this for 34 years, and the number of times somebody will be selling a property, and all of a sudden they talk to their financial advisor and say, "Well, hey, we can give you X if you just pull them, just sell, pay the tax, put the money in Wall Street." Well, that yield they're talking about is not, considering the fact they just lost 40% to tax, but exactly. using your product, it's possible to bury all the money, get the money out via the refi, take that money and go throw it in Wall Street and do that diversification you want, which is a very nice thing because the institutional TIC's not going to offer you that typically, and DSTs aren't going to offer you that. So to have that as an opportunity, and Tom and I usually, when we're looking at that and having people that are interested in doing that, we'll say, okay, well, 721 may offer you the ability to get some money, sell through the basis after it's gone into the UPREIT, but you got to sit there for a couple of years before that thing happens. So I can see your product, one, that ability to do that if you want to diversify, that's a very attractive thing. Or the ability to, bury your exchange into your product, pull some money out via the refi, then go buy other things. Everything else you buy with a refi money, your basis is the purchase price instead of carrying that low basis forward. The other thing that I just, back Tom's comment earlier about, selling is so you're buying things, you're owning that specific asset, but one of the biggest objections we have in the DST space is that hold, right? And what's funny to Tom and I is that sometimes when things short cycle, same people who are upset that they had that 7-year hold are now upset that it's short cycled and they're going to go buy something else. And just for the sake of the conversation, about 80% of our DST investors end up, when the assets go full cycle, they buy it again. But this is one of those things where that liquidity issue goes away. Am I correct in saying that?
Yeah, I mean, you're in for 10 years if you want to be in for 10 years and nobody can take. Also, when the product was designed, one of the limiting factors of triple net is that the tenant is in complete control of your future, okay? And most people kind of like that. However, let's say we have a lot of inflation and your contract that you have with your triple net isn't that great. The rent bumps 1% a year, which is nice, but when inflation's raging at 5, 6, 7, you don't really want them to extend for 20, 30 years. So this lease ends at 10 years. Now you have the option to release yourself if you want to negotiate with them, which is great. So that adds more flexibility. But more to the point, you guys have been around a long time. You understand that in a 1031 exchange, the primary thing is the fact that the safety of the investment. Okay, you don't want that thing going to zero. I mean, the tax ramifications are huge. So in order to mitigate that, what we like about this product is that first of all, we're in complete control of it. So we don't have to worry about someone else making the wrong decision, So that's part of the greatness of it.
Yeah, it puts the sponsor firm, Appreciation Homes, back on an obligatory basis, right? Not a best efforts basis. We have to pay out our net lease payment, our NLP is what we call it, to investors. Otherwise, if we default on that payment, our obligation as the master tenant, the clients take the home, the owners take that home from us. So it's very much aligned with owners and investors.
I mean, what sort of, talking numbers, what sort of return are people typically seeing on these properties?
Yeah, it's interesting. So every DTS, every direct title security is its own security. So when I work with reps and investors, I send them out a brochure and a generic PPM, okay? Because that PPM is not tied to any set of properties, right? It's a generic PPM talking about the product overall. But every DTS has its own portfolio of 1 to 15 homes. And so that's going to come with its own PPM supplement that's going to say, okay, and with every set of homes, there's going to be different markets, and those markets are going to yield something different. So I would say very broadly, and we can customize each portfolio to what the investor is looking for. If they're looking for more income, we can get close to a 5 cap. If they're looking for a little bit more growth, maybe we can be able to put together a portfolio of tier 1 markets that are yielding low 4s. So 4 to 5 is right where we're targeting. probably with a total IRR of somewhere between 7 and 9% after a 10-year hold. So, this investment is not for the deal chasers that are looking for value add and vacancies and everything else, right? Looking for a 20% IRR. This is a preservation of capital, control. Yeah. They have control, they have liquidity, but they have that same passivity that they find in the triple net structures that exist and the DST structures that exist. But we just married those two aspects together to provide this structure.
Yeah. I think it's also important to say, that we've talked to countless amounts of realtors, and just to kind of get a sense, because ultimately the realtor is kind of in control of a 1031 situation. Yeah, the client's ultimately in control, but the realtor is the one who leads them to where they need to be. And the beauty of this product is the best aspects of triple net married to the best aspects of fee simple ownership. That's the hallmark beauty of this product.
Yeah, great, good security. You get the advantage of maybe buying in tax advantage states and still the no management. That's great. Good stuff.
Yeah, I think, we look at the market today, and I just left a business forum on AI this morning, but I ended up finishing up the meeting with some financial advisor people and some real estate people, and Forrest, back to your comment about, we're in a world that's changing, right? And so I think that you've got to look at, if somebody's reaching, and we'll go back to your conference last spring. If I listen to those 40 pitches, which Tom and I sat there and listened to them, you had yields everything from probably like 2.5 to 20, right? And if I say, okay, hey guys, the guy that's telling me I'm going to get 19 or 20, are you going to be running that way these days, right? And so, what good is tax deferral if what you buy goes away? So I think Tom and we have more people that are more concerned with wealth preservation, and I think rightfully so at the moment, than ultimate ROI on stuff. So the ability to, and back to your comment, Forrest, on, let's just look at, since you brought it up, Walgreens. I mean, it went coast to coast, built real estate to sell to investors, triple net, passive investment, big box, and that was a company that was growing coast to coast. Now we look at a market since COVID and all, you start looking at the Bay Area, how many of those stores have closed? And I think your point is a critical one. You bought it based upon the income. That's how you're doing those numbers to make that acquisition. And now you got an empty building, and that number no longer holds up. And I think we're in a situation where you start looking at buildings. I mean, people were buying things based upon free money and expected the values to be based upon that thing. And now they're looking at refining in a market where their interest rate might be twice what it was. Maybe the tenant is not there, or back to your comment earlier about those leases are not drawn for the benefit of the property owner. That lease is all about the tenant. So it's interesting when we now start and we look at contrasting that product to what you guys are talking about today. And I think it's interesting. So is there a floor to investment? Are these sold typically through the securities world? And is this a situation, Tom and I, we talk all the time. I mean, our background getting into the 1031s was buying little rental houses and making them better and that type of stuff. But as far as our own kids and their ability to buy a house today, I think it's really sort of tough, because I historically, real estate, a primary residence was the best piggy bank for somebody. And for so many, that's not even a possibility today. So what kind of, what does somebody have to be to be able to buy some of your product? And obviously we've been talking from a 1031 context, which it's compliant for, but I'm sure you just take people's money. They don't have to do an exchange to get into your product.
Sure. I mean, obviously the minimum entry is a house. Good old days, right? Before syndicated real estate, which makes it also easier for when you have to identify properties. People misidentification all the time. They choose 3 DSTs and they don't really put the percentage down. So we don't have those issues, obviously. One more point back on the triple net. As they like to say, the devil's in the details. For example, Walgreens, triple B minus rating. Everything's great. All of a sudden the rating drops. All of a sudden the bank starts sweeping all your money. Right? You don't have any cash flow. In this particular case, the detail,
If Appreciation Homes gets their rating lowered, it doesn't matter. The debt that you got came from Appreciation Homes, so it doesn't matter. Anyway, but back to the other equation, we are after, to some respect, the DST market. We think it's a better product. But more importantly, we're after that mom and pop person who says they just want to do it themselves, okay? So they're getting older and they say, well, if I get older, I'll just hire a property manager. And then that's great. The only problem is that you still leave yourself open to all the vacancies and all the costs of increases. So our product even works for that person. They're the person that's not even in the market for 1031. You don't even see them, okay? Now they're going to be in the market. Maybe not for 1031, but just owning real estate, as you said, right? It's a great way to own real estate. It's great for insurance companies. We'll slap a 30-year lease on this. We'll kick the yield up by 50 bips. And the insurance company said, hey, we're not going to worry about anything for 30 years. So that's the flexibility of the product.
So as far as minimum investment into it, and does it require somebody to be an accredited investor to buy it as well? And as far as buying it, who are they buying it through?
Yeah, so minimum investment, price of a single home values range from $250,000 on the low end. I think I actually don't know if I've seen one lower than about $256,000 to the high end being $500,000. And now keep in mind, if they decided to fully leverage themselves up, the true minimum would be $100,000. They can take out a $160,000 loan and be pretty highly leveraged, but they could come in and buy a single property, right? A $260,000 property. So that's the true minimum. And yes, the DTS is a securitized vehicle. It's a Reg D 506C. So for all those listeners who don't know, yeah, we're registered with the SEC. And a Reg D product just means you have to be an accredited investor to get in. So all of the minimum thresholds, whether that be net worth outside your primary residence and income thresholds. So that's how investors would come into this product. But yeah, it could be qualified money. It could be a 1031 exchange money. It could be cash. It could be really anything if they want to get into passive ownership of real estate.
So just I want to hit on what you just said. Qualified money. So for our IRA 401k clients that are interested in buying real property without potentially crossing any lines as with respect to a prohibited transaction, this is going to be a great instrument because our clients aren't going to be tempted to go out and work on it. They're not going to have to go out and qualify for a loan if they want a leveraged investment. You're going to offer all that. So really, it's a pretty nice investment for somebody with an IRA 401k that wants to diversify into real property, it sounds like.
Yeah, I can't comment on the loan part. I don't know if you can take on debt.
Yeah, I mean, if it's not recourse debt, then I mean it should be compliant. And I guess the one comment I'd have is if somebody uses a 401k plan, they go out buy one of the Appreciation Homes at 50% loan to value, they're not going to have any tax exposure on the leverage. Where if you took an IRA and buy a leveraged investment, that 50%, half the income or half the gain would be taxable due to the fact you're making money off other people's money. So that would be the issue. But as far as what Tom and I are concerned about for our IRA 401k clients is it's just got to be non-recourse debt. So it sounds like this is all going to take care of that.
Yep.
Yeah, and can we clarify, because that might be a little bit confusing. There's we talked about these properties are going to be debt-free properties, but then we're also talking about if you wanted to go into, as your example, Derek, where you've got a $260,000 property, you're putting 100 down. Is the financing then through Appreciation Homes for the initial purchase, or how does that work?
Yeah, the financing is through a partnership that we have, a white label lender, basically. And we can go get non-recourse debt for, before close. So in this case, that would be before close, right? They come in with $100,000 cash and they would get a $160,000 loan that they would have to walk through the basics of applying for. But again, the lender knows our product. They know Appreciation Homes. So it's just a handheld through process
I would say it adds a couple of weeks to the closing to add debt to it, which is pretty standard. And yeah, so it's very clean.
Yeah, no, I just wanted to clarify that because I think that people might have had the misconception initially that they had to buy all cash initially and then they could put debt on it afterwards. But
no,
okay.
yeah, you could buy all cash, or you could add up to about 65% loan to value.
Like we're working on a deal right now. Derek will tell you 1.4 million or whatever, and some of the yield and profit.
Yeah, so we're putting together a portfolio currently for a client that's in about a we'll just call it $1.4 million exchange. They have, let's see here, I think that was 750,000 of equity. It was about 42% loan to value. So, we put together a portfolio that was yielding, from an all cash perspective, it was yielding about 495 or 5. And obviously there's the debt service that's required, so that's going to drop the yield down. Rates, I think for that debt that he needed, $550,000-ish, we were able to get the rate down to about 578. So it's negatively leveraged, but with rates coming down again, it's beneficial for us. Our lender changes the rates in the market. So we were able to put together that portfolio, and on a leveraged cash flow perspective, it was yielding about 4.2, and it was about again about 43% loan to value. So in the market, you can go look at some residential DSTs, multifamily DSTs. Look at what they're yielding in terms of if they're up at 43% loan to value, and if they're yielding 4.2 again. But then again, you have to ask yourself, how much money or how valuable is liquidity and control, right? I mean, would you say it's worth a point? So here we are giving investors liquidity and control at any point in time for the next 10 years on title for real estate with a 4.2 cash flow on a 43% loan to value asset. So it's pretty remarkable.
Yeah, and we're at a little disadvantage right now versus the DST because of half the DSTs out there have legacy debt that's probably in the low 4s. So, a year from now, that's all going to go away and we're going to be on an even playing field. And like Derek said, what price do you put on a mitigation of the safety? DSTs are kind of like a best efforts, right? As far as getting you your payment, whereas this is contractually obligated. So, what's that, sleep well price worth?
Yeah. So back to, so is just, I want to once again delineate. So Appreciation Homes is the tenant of the property, right? So, I mean, it's Appreciation Homes is a sponsor. They put the packages thing, get it all set up. They're the tenant of the property, and they're effectively the manager of the group of assets too. Do they actually do the management, or are they contracting with regional management companies to take care of that? And I guess, a couple of comments. I mean, Tom and I are in the People's Republic of Portland, right? So homeowners have no rights of ownership these days. And one of the nice things about DST and Derek, you commented 45 days, and Tom joked around it. It's nothing to get things handled, or to get things, or actually you said 48 hours to find portfolio substitute, not 45 days. So people that are living off this stuff, they're not going to have much gap in income buying your product, obviously. If somebody owns a rental house, and this is a thing that sort of drives me crazy with the accredited investor rules. It's like, okay, you can go out and buy a rental house. You don't have to be an accredited investor, and you might be totally out of your league managing the thing and incapable of doing it. And with cities and states, governing how you actually do things, who you can rent to, everything else, you're vulnerable for a whole variety of reasons, let alone just trying to get insurance these days. But it seems to me, you don't have to be a accredited investor to go do that directly, but to hire somebody that actually is a professional doing it, you have to be an accredited investor. So that drives me crazy a little bit. But it just seems like, with the structure, and we've got a couple of, sponsors we've had some hiccups with in the DST space. We won't go into any names, but there's some issues there. Derek, your comment about, each asset standing on its own, and, if appreciation defaults, you're still the owner of the property and you've still got a tenant there. It's just, you're sort of changing how that works, correct?
Correct. Yeah. It's not a painless situation, right? We're talking about worst case scenarios. Appreciation Homes files Chapter 11. We disappear. We go away. What is the investor left with? Well, yeah, they have to go find a management company, or they have to manage it themselves, or but yes, ultimately they're going to have real value in a single family home with a subtenant likely in place, right? We're talking about residential real estate here. It's low cap rates for a reason, because tenants are a dime a dozen. But I'll also go back, because you said something just now that I want to clarify. As we know, 1031 exchanges, you have the 45-day identification period, and then you have to close within 180 days, right? So it's in that 45-day ID window, that takes about 48 hours for us to produce a home or homes for them to ID. But in terms of closing, it would take a couple weeks, right? We couldn't, just because someone's going to ID within 48 hours or shortly thereafter, that doesn't mean we can close within enough, like at that moment. We can't close as fast as a DST. It'll take 2 weeks to close, probably, for all cash transactions. And if they want to add debt, it would probably add another 2 weeks. So you're looking at a total of either 2 weeks or a month to close on a property, depending on whether it's all cash or with debt.
And what, of course, with the typical single family, you're going to have inspections and so forth. Who takes care of all of that? Is that something that you guys do? Do they have eyes on reports? And what's that buying process like compared to me just going out and doing it on my own?
Well, I'll just say that Appreciation Homes ultimately is not going to put their lease on a house that they don't want to ultimately take back later on. They're planning on doing a REIT, just like all the other DSTs are, 721 up REIT. So it's very important for them to put you in a house, because don't forget, they're paying you a net lease payment that starts off above the market rate, okay? And then ultimately they're counting on pushing the rents on the native side so that ultimately they make the spread. So their interests are aligned more than any other sponsor in a typical DST. So they do everything, soup to nuts. They take care of everything. You don't, as the investor, you don't have to do anything.
Yeah, and we've partnered, to go back to David's comment about who are we managing these ourselves? No, we have a relationship with and a partnership with one of the largest home property management companies. I think they manage about 35,000 homes. They're backed by one of the largest private equity firms. I think ResiCap, if you guys are familiar with them. But anyway, they do all of our property management for us. So that's not it's not burdensome for us to be spread out across markets.
So back to sort of dovetail into what Tom was asking. I just want to be clear. So back to the initial comment on an institutional TIC, the sponsor doesn't own it. They're filling the bucket with investors. When it's full, they buy it. In this situation, Appreciation Homes owns these properties that are being offered to the people, or are they buying the properties that the people are interested in buying?
Well, they're facilitating the sale from a build-to-rent community developer to our client, or to the investor. So they're just there as a middleman. They don't warehouse any properties. They don't. That's not their business.
We don't have an inventory of homes. Yeah.
So it's sort of working like that TIC deal. And so if that person passes on it, the property's not going to be purchased by Appreciation Homes. They're only buying it if they've got an active investor that's interested in it.
Exactly.
But you guys have the money available there to make it happen quickly, and the program's in place to do it. And then, so let's say I buy something outright, and then a month, 2 months, 6 months later, I say, hey, I'd like to pull 25%, 50% out of it. What would be the one? I think we've discussed that that's possible, but two, what would be the timelines or parameters that have to be met to do that?
I would say that it takes a couple of weeks to probably make that happen. It would be the same process as applying for a loan prior to a closing. It'd be the same process if they wanted to pull it out. It's the same idea as if they wanted to pull out money from their investment property right now, right? They would have to go to the bank, apply for that debt. But it's just, the process is just going to be cleaner and more simpler using our white label lender. But you can just expect it to probably take a couple of weeks to do that.
I mean, the client doesn't even have to worry about paying the bank the mortgage. the mortgage payment would be taken out of their net lease payment. So no chance of default by the client.
So what's interesting, I mean, I just keep coming back to that cash out refi situation because it's I feel like it's something that is of tremendous value that people don't really think about because they haven't had that ability. But to have that access to capital that way, and even if you're, I mean, Derek, your involvement in this space is, fairly short, and you're really approaching it through this Appreciation Homes vehicle, which is awesome because it's opening up a whole nother channel. Forrest, you're probably you've been around long enough where you think about the investments that you've sold to people where they have no debt possibility on an offering where somebody needs debt to go do something. And I just feel like this is a tremendous solution for a problem that a lot of people didn't know was a problem maybe, or didn't know there was a solution to.
Yeah, exactly. I mean, I think some of the issues, it's a new product, and I think that a lot of the reps are so used to doing DSTs that they don't really have time to take their mind off it, if you know what I mean. New products always take time for a reason, but the really good products that are new ultimately bust through. I mean, let's go back to, you're familiar with 2008, 2009. I mean, the tick market basically, what?
Painfully aware.
Exactly. I mean, the tick market blew up, and the reason why it blew up was for the simple reason that nobody had control. And the fact that you needed unanimous decisions on everything under the sun made it an untenable position. And it sometimes takes a black swan event to show that there's holes in the roof, and so the DST was born out of that. And now, as you alluded to earlier, with no names being mentioned, DST markets are showing that, they're not the absolute safest thing in the world. So I think through this trouble with the DSTs, I think people are going to naturally look for something like this, the DTS, that gives them a mitigation of risk, but also liquidity options that they're not familiar with. So we just need to convince the reps out there that this is not, we're not trying to make enemies of reps, showing them something that may be better than the DST, but something that can be blended. It's going to start out as a blend. You have an exchange for $1 million. Maybe you buy one house, and then you fill it in with DSTs, or maybe you buy two houses. I mean, that's how it's going to start. And then just slowly but surely, we'll start capturing, 5% of the DST market, 10%, and hopefully get people that aren't even in the 1031 world. The property managers, the people that want to do it themselves.
Yeah, again, it comes down to diversification, really. And so many of the investors that are in DST started out with single family, and they may have gotten out of it because they didn't like the management part of it. It's a lot of doors, and so, but bottom line, they're great investments. Helped them build a lot of wealth, had security, and direct title, had that ability to refi if they needed to. So you've got a lot of that stuff again to add to it. And I know we've got a lot of people that go into DSTs, and for the most part, they're very happy with them. As David said, we get a high percentage of them go back into them. But I do know we've got enough people in them. I do know of a couple of people that if they had, they want or need some money out, and with the current situation, they can't do it. And they're kind of waiting for a sale transaction. And where if you had this ability to do a refi, it's just would, maybe they don't need much, but it would certainly give them a great option. Yeah.
Well, Tom, how often do we have somebody ask us, it's like, okay, so if I buy something, if I buy into let's say a DST, well, what if I want, or how often do we have somebody say, hey, can I go buy something until, right? Just to buy something that has to meet that 45-day ID period, but they ultimately don't want it. They just want to buy it to satisfy the exchange and go do something else. So how often do we have that conversation and think about how this would effectively accommodate somebody that needs to bury the money, but then when they do find the ultimate investment they want, they get access to money via the refi?
Yeah. I mean, it happens a fair amount, and they can't just buy something with the idea that they're going to turn around and sell it again, of course. But if if they buy into something and maybe maybe even really like the product, but would rather own in a different area, it certainly would give you an option to do this and buy. Maybe you're buying someplace in the South and you want to buy someplace else. You could always do an exchange out of it whenever you wanted to and buy something in a different area. Sometimes people want to be close to their investments. Sometimes people don't want to be anywhere near their investments.
You know, and one thing, if you don't mind, David, sorry, were you going to say something?
No, go for it.
One thing too, an aspect of this product that we haven't even talked about and probably should have addressed right off the bat, but it's too bad we waited so long, is that, you know, again, if let's just say back in 2022, the 1031 market round numbers was $100 billion, right? $100 billion was 1031 in the United States. About 10 billion of that, or just under, was to the DST market. So about 10% of the market is to securitize 1031s. 90 billion is fee simple real estate. That's where the national brokerages make their money, right? You have all of the commercial real estate brokers and real estate agents out there that are dealing with that fee simple transaction, real estate to real estate, or fee simple to fee simple. And, you know, I would say, hey, well, does the DST market really limit itself to 10% of the market? And I think it's for three factors: control, liquidity, or lack of control, lack of liquidity. And then also, as you guys know, there's a natural barrier that's occurred from just an unfriendly relationship with real estate brokers, because if a client does want an investor to go into a DST, that's a securitized up leg, which means that there's a commission, there's a securities commission related to a DST, and the down leg is a real estate commission. So you can't really share those things unless that real estate broker is also securities licensed, right? So it creates a very hard situation where real estate brokers aren't necessarily looking for their clients to go into a DST or any securitized vehicle for that matter, because they're not going to double end the deal. So, you know, again, I think that's a big factor as to why DSTs aren't expanding more into the market, right? Just as with everyone, we're all fee incentivized. But again, with our product, these homes being sold currently in a transaction from a home builder or a large institution, that's a real estate transaction occurring. You know, so you know, let's just say Lennar is selling this home. Okay, there's a real estate transaction occurring where there's a buy side and a sell side broker. We are in all intents and purposes making that broker that brought the client over to the DTS the buy side broker, and we can pay them up to 2.5% on the total sale price. So that's debt and equity. So it's not, and that's completely above board. That's you know, before it becomes a security or anything like that, we're just giving them the real estate commission of the buy side broker, brokerage commission to that buy side broker. So it's, you know, it's gonna. I really hope to see that changes the game. Yes, this is a product that we need to educate the registered reps out there, QIs, everyone else that's associated with real estate, securitized real estate transactions. But at the same time, I spend a lot of my time actually educating commercial brokerages and real estate agents that need to know about this product, because again, you know, they're dealing with that other 90 billion and they're looking for a passive up leg, or they can help them shake loose some properties that they would have otherwise not been able to shake loose. Again, like Forrest talked about, you know, this is hopefully going to get people, you know, to 1031 that otherwise weren't going to, you know, and it gives these brokers a competitive advantage to, hopefully win some more listings as well. So, you know, that's just, again, for your listeners, I think that's a pretty valuable thing, for reps to really nurture those centers of influence that they have with commercial brokers, but then also for the commercial brokers out there to know that this product exists.
And the other thing is we've alluded to before is liquidity costs money, right? You go to a bank with $100,000, they say, hey, I need it next week. What do I get? Well, you get nothing. Okay. But you say, well, what if I put in a 3-year CD? Well, we'll pay you 4%. I go, well, that's a big difference, right? So liquidity costs money. So this product, even though the yields are slightly higher than DSTs, you have the liquidity, but you're getting it for free. So there are just so many advantages of the product that, you know, it just keeps growing and growing and growing.
But are there any limitations? Of course, in the 1031 world, we have title vesting sometimes becomes an issue. Is there any limitations on, because we're talking about single family properties, if there's financing, is there a problem in getting financing and title in the name of LLCs or trusts or anything like that, or does it have to
No, because these are single member LLCs. They're disregarded entities per the IRS. So you just look through it. It hasn't been an issue. Shouldn't be an issue.
So title is always taken in an LLC?
Yeah, absolutely.
Yeah, every DTS is technically its own LLC.
Yeah. I mean, wealthy people wrap their properties in LLCs all the time.
Yeah. I realize that, but if we're doing a normal, if we've got an exchange and somebody's going into a single family, a lot of times the lenders will lend to an LLC. So I just wanted to clarify that. So if I've got somebody that's exchanging out of they've got their relinquished property in a trust, they could buy into this asset in an LLC that's now owned by the trust.
Yeah, the Social Security number remains the same, and like I said, it's a disregarded entity.
Sure. Great.
So I want to sort of piggyback on that because Tom's point. So the biggest headache we've got in any exchange is time. The second biggest is vesting. Tom and you guys are in California. We grew up in California. We're sitting here in Portland, Oregon, right? So California is a community property state. Oregon is not. So if we've got Oregon clients wanting to buy into this product, you just said that it's always via limited liability company. We're going to have two for spouses because, I mean, spouses in the state of Oregon are a legal partnership. So we'd have to have, if we have somebody coming out of Portland into one of your assets, it would require ownership via two different limited liability companies, effectively tenancy in common. Is that an issue, or is that something where we'd have to get involved with the deal earlier, have these people contribute, their relinquished property into a limited liability company, let's say, before they do the exchange?
Well,
I'm sorry if I hit you with something you hadn't thought about, but I mean, it's just something that we have to deal with all the time, unfortunately.
Yeah, I not being CPAs, I don't know, but it would seem to me that as a married couple, that would still qualify as a single member LLC.
Not in Oregon, unfortunately.
Unfortunately, yeah. They do in all the community property states, of course. So we've got you guys in California, Washington. So we've got neighbors north and south. Yes, it is a single member. It's treated as a disregarded entity for tax purposes, but Oregon it's not.
Oh, interesting.
Welcome to our wonderful world. You're trying to be logical, Forrest. Come on.
But again, it's something that we can figure that out. And it's just something that maybe takes a little bit of planning ahead of time. And
yeah.
Not something that we're unaccustomed to, certainly.
Sure.
So as far as, I mean, this concept, you went through a little of the history. It's pretty new, but as far as traction, you're getting traction in the space. Your typical investor, sort of what was that investor look like, and maybe give us a couple of success stories, and then we'll wrap it up. And I think what I'm going to invite the audience to do is, I'm sure it's a new concept for most everybody out there. So if you've got questions or concerns, things that you'd like us to address, I'd really like to, obviously Tom and I really enjoyed our time with both you guys down there, and look forward to doing a lot more work with you going forward. Just playing together too, right? But as far as things that you think are really important for the audience to understand, for the audience, you got questions, get them to us. I'd like to do a follow-up with you guys maybe another 6 months and say, hey, how's it going? What have we seen as far as progress in it? And some stories of success right now would be good. Sort of, I mean, you mentioned the one guy that you're putting $1.5 million into some stuff, but maybe a couple of great stories for the audience right now.
Sure. So we've had a few closings. We've one of our first closings was someone that just had an exchange for just under $1 million. They were all cash, no debt, so it was very clean and simple. We found 3 homes for them, 2 in Alabama, 1 in Georgia, And the process was very good and smooth. So now, again, now that client, and I actually, I think that the rep also diversified with some other DSTs as well. Again, so even if you're a rep out there and you're thinking to yourself, well, where does the DTS fit in? Maybe it doesn't fit into the whole exchange. It's a $2 million exchange, but I would encourage reps to at least think about this as, what liquidity and control are you providing for a client in their total exchange? So even if you were to buy 1 or 2 homes of Appreciation Homes as DTS, right, you're getting investors a liquidity and control aspect of that exchange, and maybe you're putting the rest into a DST. Okay, so first, I think that was a success story. Client was very happy with that closing. A couple other, or most notable one that I can think of off the top of my head, is a client actually diversified themselves into our lease terms. So they had, I think, a total of 4 homes. 2 of them had the 10-year lease on them, and the other 2 had a 30-year lease on them. Just something that the client, I think they were okay with having a 30-year lease with Appreciation Homes. That, again, like Forrest says, that bumps up the yield by about 50 bips because we start investors out that much higher above market. But again, then they're not going to really see that home, or they would sell that home, for 30 years, it's going to be tied up with our bondable lease on it, right? But then at the other side is they had a couple 10-year product too. So, we've probably done a few million of closings and looking to do more, obviously. But yeah, those are a couple success stories, and working with a lot, like I said, a lot of reps throughout the country and real estate brokers as well.
I think one thing we haven't commented on is one of the reasons people don't want to be the first to do this, because we've talked to many of the big reps in the industry, is one is to say, hey, this is a new sponsor. How do we know that they're solid, this, that, and the other thing? Now with the DST, of course, you really want to know the sponsor. I mean, everything is resting on them. But in this particular case, obviously, not everything's resting on them. So just to be clear, Appreciation Homes has, well, first of all, their background, they manage hundreds of millions of dollars on the triple net side. They're very, very good in real estate. But currently, they've got about $300 million in leasehold interest from major build-for-rent community builders. So as those houses come online, in order to not have to sell them and pay, short-term capital gains, they want to, stretch it out. So they've hired Appreciation Homes to put leases, 30-year leases on their homes. So like I said, they've got about $300 million as the homes come online. So it shows you that they're not a fly-by-night company, which is important for people to understand.
And though it's the DTS is a new product, you got to, I think your listeners would be very much understand that there's fundamentally what's happening is not new, right? Fee simple ownership of single family residences is not new. That's as old as time. Triple net leases that are in commercial real estate, that's not new. That's, but when you marry those two very traditional aspects, you're getting a very conservative fundamental approach to 1031s, right? So the product is new, but there's nothing new that's really occurring, right? Fee simple ownership of single family homes married to a 10-year credit-tenant lease.
Yeah, very, very established companies offering very established and tried and true investments, just in a different manner.
Anything?
Like it. So at this point in time, if somebody wants to get a hold of you guys, obviously, like we discussed, it's being sold through the securities channels, although real estate people can receive some compensation. So why don't, Forrest, why don't you start off who you are? If somebody wants to get a hold of you, why should they get a hold of you, and how do they get a hold of you? And then Derek, finish up with you doing that, and then we'll wrap it up.
Yeah, okay, yeah. Like I said, we have a retail arm of it's called Irvine Advisors, but I also do business as Emerson Equity. We're supervising principals for the company. I have a lot of experience at DSTs and DTSs. In fact, I can say that probably nobody knows more about the DTS than I do. But that aside, they can contact me at fjames@emersonequity.com if they're interested in moving forward. And Derek will give you his information.
Sure. Yeah. And again, if there's reps out there that are with other broker dealers that might not have a selling agreement, I would encourage them to reach out to me. We can start the due diligence process, get this on your platform so you can start selling it. Or if you're a real estate broker and your client is very interested in it, Find your local rep. If you have a rep that's doing it already, it's got to go through a registered rep though, obviously. But I'm the regional sales director right now. My region is the whole United States, at least for the time being. So you can contact me at Derek, DEREK, at appreciationhomes.com. And be happy to connect again if whether it's a real estate broker or real estate investor or a registered rep with a different broker dealer outside of Emerson. Happy to connect.
Great.
Tom, you got
Great. Any more? Not really. It's just great to talk to you guys about this. It's a very exciting product, and for us, it's always so nice to have something else to provide to people. It's we obviously believe in the 1031 product, and it's not a hard sale, and just having more material to give, more options for people on the buy side is fantastic.
Yeah, so I want to just stress for the audience, Tom and I do these for our audience benefit. We want our investors to be well educated. We want the brokers we work with to be well educated, know what's possible out there. We don't get compensated anything. If you buy anything from these guys, they're not paying us anything for referrals either. So this is just for informational purposes. We want people to understand what's out there. I think, Forrest, your comment about dipping your toe in the water. Hey, the great thing about a DST is you can diversify into a variety of things. I think this is just another level of diversification. I think the things that really honestly excite me about it is just the isolation of the assets, right? I'm not dependent upon what a sponsor's doing with other things. I've got specific things that I own. The opportunity to do the cash out refi is an amazing thing that's not possible with a lot of investments. Non-recourse debt. So for Tom and I, that's important because of for anybody, I think it's important because these loans aren't going to be subject to you, your income, your credit, or anything else. But when we start looking at qualified money buying into these things, I think that's a real opportunity for people to take their IRAs and 401k plans, diversify into real property without having to worry about jeopardizing something through a prohibited transaction, signing the wrong line, doing the wrong thing with the financing or insurance or anything else. So I think to have a passive, real property investment is a wonderful thing for that space. Tom, did you have any comments on that?
No,
So
said it all.
Yeah. So with that said, Dave and Tom Moore, the Exchange Brothers, we've been blessed to have Derek Vogel and Forrest James here with us today talking about Appreciation Homes. You've heard where you can reach them, and I really encourage you to give them a call if you've got some comments, questions, suggestions for future content. Please do not hesitate to let us know. Dave and Tom Moore, Equity Advantage, 1031exchange.com. And guys, thank you so much for taking the time today, and look forward to seeing you in person again soon.
Thank you.
Yes, sir. Thank you.
Thank you.
Thank you, David. Thank you, Tom.
Thank you.
Take care, guys. We'll see you. Bye-bye.
Bye-bye.